TV and radio.
All right. What's going on, guys? Nope, we're live now. Use the way you joined the link, that's how you see it. Yeah, nobody. I know most people are just waiting for this one, that's why. But I do a refresher afterwards. Make sure that in the central banks tab, I put everything in there so you could see what happens. How you guys doing so far? What's up, Tiara? What's up, James? Farco, what's good, guys? Eddie, Anthony. Yeah, it's been good. It's been good. All right, let's get it started, guys.
Recording in progress.
Yeah, I'm still holding AUD USD. Like, you see how the meeting goes. In order for me to hold it a lot, for me to hold it longer, we see how this meeting goes. But I'm also going to probably look for another trade, break it down also. All right, so for this rate decision, it's a very high probability, around 90% chance of the Fed's cutting by 25 basis points. So usually the Federal Reserve don't like to they don't like to shock the markets. Most likely when they price something in, usually the Fed's typically follows that. Mostly other central banks don't really care, but the Federal Reserve do care about that. But just for instance, right, just in case if it does happen, if they pause interest rates, right, they leave rates the same, that's going to give a hawkish reaction. All right. So just remember that if we look at when the rates come out at 2 and we see that the rates are left the same, we're going to see stronger dollar. We're going to see equities push lower. It might be extremely aggressive. Okay. Another surprise is if magically, but in high probability, this won't happen. But if they do cut rates by 50 basis points, that would weaken the dollar. It would strengthen equities, but I don't think that's on the table. I think what's on the table is it's a chance. There's a few banks that put their forecasts expecting a pause. I think it was like 4 or 5 like really big banks that they gave a possibility that this meeting could be a pause. Okay, so it could go either or, but it's still overly like a 90% chance of a cut. So we're going to be looking at scenarios, because what makes this rate decision a lot different is the fact that we do have the dot plot. Okay, so we have the dot plot for this meeting. That is the reason why this one is actually different. So we're going to look at scenarios. Okay, there's going to be 3 scenarios that we're going to focus on. It's going to be a dovish outcome, an inline one, or a hawkish outcome. All right, U.S. Headline, U.S. sees oil tankers off the coast of Venezuela. Yeah, we're going to see Venezuela headlines going crazy. All right, so we're going to look at 3 scenarios. Just to speed it up, we got 20 minutes, okay? So just take your time. If you guys have questions, write the questions down. Let me know so I can help you guys out. But I'm pretty good at explaining everything, so it could help you guys really understand what's going on. So when we get a dovish outcome, what we want to focus on, if they cut rates by 25 basis points, which is already expected, okay, we need to focus on what future rates is going to do. That's the dot plot. So for those that don't know what the dot plot is, all it is just all the Fed members voting where they expect interest rates to go by the end of that year. All right. So if the dot plot of 2026 is lower than last year's, right? If they expect more rate cuts, if they signal additional rate cuts ahead, right? That's what's going to cause more of a dovish outcome. Forward guidance. So when I say forward guidance, this is just when Jerome Powell speaks, or when we get the press conference, right? Or the paper that we get a bunch of headlines on. We want to see what is their direction in the future. So that's forward guidance. So if the committee says they consider additional adjustments on interest rates, right? They're clearly open to cutting more if labor market weakens. That is a dovish statement. That would lead more for a dovish outcome, which is weaker dollar, stronger equities. We want to also see comments on inflation. That inflation pressures are moderate is usually the terms that he likes to say, but it means that inflation pressures are coming down. Okay, in simpler terms, but they used to use these type of words for their language. So upside, like if he says like upside inflation risk is cooling off. You know, we see stuff like this, or there is a term that they was expecting higher inflation was concerning them because of tariffs. So if we could see that his language is different on that, if he's a little more confident now that those inflationary pressures we was worried about is now diminishing, right? That is what we want to hear about inflation going down to target. Then also if he talks about growth, if he's admitting that growth is getting weaker, that is a huge sign for additional rate cuts in the future, okay? Then when he talks about the labor market, we want to see continuations of weakening in the labor markets. That risk is being tilted to the downside. He likes to use the term risk tilted to the downside. So when we hear that type of language, right, the market scared the hell out of me. All right, so the market reactions, we want to see weaker dollar and weaker yields. All right, then that is going to cause equities to go higher, and then gold is going to go higher. Right. So that will be the dovish outcome. In line, like pretty much everything. When I mean in line is that whatever they said is as expected. OK, so that is as expected, which is like if he's just trying not to give us a direction. Right. If he's like inflation is lowering, but we're still inflation is lowering, but we're still going to be patient. You know, that type of tone where he's not giving a directional bias. That's when we just leave the markets alone. All right. Where he's giving 2-worded answers. And this is Jerome Powell. He's been doing this for a very, very long time. He is really good at that shit. Like he is really good at giving us a hawkish comment and backing it up with a dovish comment. He is really good at that. He's really good at giving a whole lot of nothing, you know, when it comes to his answers. So we have to really pay attention to what he is saying. It's his job. He's extremely good at that. All right. So that's what we're going to focus on. But the hawkish outcome, you think they're going to be hawkish? I have a possibility. I think Jerome Powell want to say F you to Trump. Right. But it's a possibility. Right. If we get a 25 basis point cut, but with hawkish language, that's what we're going to focus on. Okay. So remember what I said about the dot plot for a dovish reaction. So that means if this dot plot, those numbers are actually higher. And I will show you an example of that. If the numbers are higher, right, signaling probably only one rate cut or less, right, or no rate cuts, that would be just an automatic hawkish reaction. Okay. So fewer rate cuts for the next 2 to 3 years, hawkish reaction. So right now, I believe they're every other year. I think it's only 2 rate cuts being priced in. I think, yeah, like two rate cuts for next year. And I believe the year after that is like 1 rate cut. Okay. So it's about 2 to 1 rate cuts moving forward. Right now, that's already priced in. So if we get between 3 rate cuts and down for next year, that's dovish. But if it stays at 2 to 1 rate cut, that is most likely going to be considered hawkish. And we're going to see that in the dot plot. Forward guidance, right? When he's talking about further cuts is unlikely. Thanks, Leo. Yeah, so 2006 is 2 rate cuts. 2027 is 1. Okay. So if he says with forward guidance that if it's unlikely that future rate cuts is going to happen, that would be the majority of the forward guidance that we need to pay attention to. Okay. So if he explains that the September inflation unchanged is revised up. So that means if he is concerned about inflation actually staying higher, that is something that we're going to focus on. That's going to be a hawkish reaction right away. Markets is going to react to that, especially with the algorithms. When he's talking about growth, saying that growth is still solid and growth is still stable, that is not what contributes to lower inflation. So if he's saying that growth is still higher, growth is still in a solid place, that will give us a hawkish reaction, which is, I'll explain after. So the labor markets, if he says that the labor markets is also still solid, right? If he is not downplaying labor data, giving us mixed signals, right? That is going to also give us a hawkish reaction because they're not going to cut aggressively if the labor markets is still solid. Market reactions of this is going to be stronger dollar. We're going to see the U.S. yields push up. We're going to get weaker gold and then downside in U.S. equities. So that's going to be the base direction. Okay. So that's what we're going to look forward to. So any questions? If you guys are good so far, put a 1 in the chat. If you guys are good before I move forward, we'll look at trade ideas. I thought we explained that already about, yeah, thank you, Leo. So the only reason why I hold AUD from the weeks before, we had the rate decision. We've been seeing Australia's inflation data. So everything when it comes to Australia, they're dealing with the difficulties of bringing down inflation. So we just got the last inflation print. That was when I entered the trade, right? We had a higher inflation print. The RBA was hawkish. So the only downside that we had, was it this week or last week? We had weaker GDP data for Australia, but I didn't close the trade because inflation is more of the focus. And then we've been anticipating a weaker dollar this whole entire time, right? Because we're expecting rate cuts to come in. So that gave me the confidence just to hold on to the trade. It was all fundamentals, just fundamentals. That's what really came in. Yeah, you think they're going to be hawkish? It's a possibility. It's a possibility that they be hawkish. Hawkish means that the Fed, like the term of hawkish, right? That means central bank members is not likely to cut interest rates. That they either want to push up interest rates or leave rates the same for this scenario. But usually hawkish means that they're not likely to cut. Dovish is more a central bank member wants to lower interest rates. So you look at it from a perspective like dovish, central bank members want to help the economy, right? They want to lower interest rates so investors could take in more money, right? They could borrow more money. If they want to hold interest rates, right? They want to hike interest rates. It makes it harder for the economy to borrow. Should close this shade. Hawkish scenario markets, we go get a stronger dollar and weaker equities. If we get a hawkish reaction, markets would go that way. Equities is US 30, NASDAQ, and the Dow Jones. It like the September dollar sell off. Yeah, it's a possibility. Like even today, I could see like really big moves happening. Yeah, there's a few people that's expecting a hawkish reaction. Just like an example of the dot plot, it'll be like this. Okay, so this was the last one. This was in September. So if you want to see that this is different. So the majority of the dots is the sum of where they expect interest rates to go. So if we see like right here at a 3.4, if these numbers go higher to like say like a 3.8 or stuff like that, we see these numbers go higher. That's going to be hawkish. That means that they're not looking to cut interest rates more aggressively. If these dots is lower, that shows that they're more aggressive with cutting interest rates. All right. So this is like how it is. The more dots, that's the sum of where they expect interest rates to go. Like this dot right here was Moran. He's like the only Fed speaker from Trump, right, that wants to cut aggressively. So like these dots is just Moran, but that's how you could tell, and it's going to look like this also. So it's going to be a lot different when we get this. Now we're going to get this sheet as well, but we're going to be able to look at the numbers together. So we're going to focus on what they say about inflation, right? Like if they're expecting inflation to lower or higher, unemployment, it's going to be, we're going to focus on that it's still the focus. The problem is they always get it kind of off, or they're always kind of off when it comes to this. This is just an expectation. This could change this could always change, but this is just an example for you guys, what we're going to look at. All right. So now just some trade ideas, right? So whatever I draw, whatever you guys are comfortable with, that's what you're going to trade. All right. So if you trade equities, gold, I will give you areas of interest to focus on. Then we're just looking for hawkish or dovish reactions, and that's what we're going to follow. All right. So we got a few minutes. All right. So let's get it done. And yes, like the moves could be very like volatile. Don't get me like it could be very volatile. If you don't want to trade it, it's okay. You don't have to trade something you're not comfortable with, but just focus on, I would say, even if you don't trade it, focus on the possibility of a surprise. Because if we do get a surprise, you're going to want to be into that, because that's just going to be a no brainer. But like, if you're just not comfortable with it, just take the information and just know that the markets ain't going nowhere. But this is the last big rate decision. Okay. So the problem with this one is, we're heading towards the end of the year. So most likely after whatever happens from this decision, like the trading desk, these people are just going to go on vacations. Investors is going to go on vacation. They're going to leave. So that means just less liquidity, most likely probably in the next week or so. We're going to see less volume, less liquidity is going to be in the markets, because, people are going to go enjoy the holidays with their family. So always be prepared for that possibility. All right. And then I'm going to make it color coordinated for you guys. If it's a surprise, I'll let you guys know. Like usually, like it's going to, on the dot plot, I'm going to explain it, but we're going to focus on the dot plot, right? So when at 2:00, we're going to focus on the dot plot, and we're going to focus on what happens with rates. So if they cut rates by 25 basis points, that's no surprise. So then we're going to focus on the dot plot. If the dot plot shows more rate cuts, the markets is going to react to that. If the dot plot shows is going to be less rate cuts, markets is going to react to that. Right. And that's going to be the source of your entry. So it's going to be an impulse, right? Depending on what the dot plot shows, you're going to get a spike, and then it might recover till Jerome Powell speaks in 30 minutes. All right. So that's probably what's going to happen. But if it's like something that's like blatantly obvious that we should be in a trade, it's a higher probability we're going to see the moves just continue in that direction. Okay. So that's what we'll look out for. I think GU is pretty good too for both directions. Like majority of these pairs, you could trade it in both directions also. But this is just me, like when you get that break of structure, right? So that's when the arrow starts, the break of support or break of resistance. That's where you're going to want to look for your trade. If you guys can't see, just go to YouTube. And obviously in a private group, it's a bigger screen, so they're able to see the majority of the chart. So you're not going to be able to see most of my chart anyway, unless you're in a private group. What pairs you guys are going to trade, though? Yeah, gold looks good too. Yeah, USD NAS, gold and NAS. Yeah, yeah. USD JPY is good. I like USD JPY. Yeah, gold. I think gold is dope. Like gold should give a good opportunity. Just be cautious of the volatility. You know that's just really it. Just be cautious of the volatility. Let me try to give you guys. All right, so you guys can have a better view. Yeah, because you're gonna be looking at equities and gold, so at least y'all can see that. You only trade Euro USD. Yeah, that's good. Euro USD is just the opposite of the dollar. It's just opposite of dollar. That's really all it is. Yeah, and then after this, we're gonna focus on dot plot. We're gonna focus on the press conference together. It's gonna be 30 minutes after dot plot is gonna be 30 minutes after the numbers come out. So that's what we'll focus on. And then hopefully Trump don't like ignore this like do no dumb stuff. Euro, NAS. This would be my last trade of the year. It don't. I mean, if you want it to be like the markets is still going to move, but yeah, I think next year is going to be a lot better. At least data is going to get back to normal, you know, because we still got the 16th where we're going to have NFP data. So whatever happens for this rate decision, and if NFP does, and if NFP does something crazy, does the opposite, right? So say if today is a hawkish meeting and then NFP comes out dovish, right? Weak, like very bad numbers. We're going to see rate cuts being priced in, all of that stuff. So I would say probably after the 16th, then just, enjoy your vacation. Because, cause we're still going to get data and stuff. So like, I would say probably like after the 16th, just focus on inflation data, focus on labor data, and then the rest you could just don't overly trade price action. That's all, just technicals. Just focus on like stuff like that, inflation and labor, pretty much. Because yeah, we're gonna be looking forward to the 16th. Please, why do you? It's red and green. It's just like usually when we get data. Yeah, because you guys can't see it. Yeah, because usually when we get data, like right here is how we follow it. It's going to be green or red. So when it's red, it's showing that the numbers are lower. So the direction is going to be red. It's going to follow the red arrows. So when it's green, it's usually the numbers are higher, right? Hawkish. So it's going to follow the green arrows. So that's why it's color coordinated. So you can't confuse it, So if you see red and green all together, that means you shouldn't be trading. All right. But this is a highly anticipated rate decision. All right. So it's going to be a lot. It's going to be a lot of volume. So just be cautious of that, guys. It's going to be a lot of volume. All right. So I'm going to just look at USD JPY, but let's see what happens. First, we're going to look at the rate decision. If they cut rates by 25, then we're going to focus on the projections. All right. We got 19 seconds. All right, 10 seconds, guys. All right, 3, 2, 1. See what we get. As expected. So everything is as expected. So the reserves came lower, but this is not giving us an edge, okay? So they cut rates by 25 basis points. So the algorithms is what's acting up now, but this doesn't really give us an edge. Right, because we're focusing on the dot plot, but the excessive reserves is lower, so that's the reason why we got that weaker dollar and weaker yields. So I'm not in anything. I'm gonna leave it alone. I'm gonna still hold on my AUD USD trade. If this pushes lower, I'm gonna just hold on to my trade, but I'm not looking for an entry. All right, because we didn't get nothing. This is as expected. So you see it's white, so that shows it's the same as the previous. But we could get a weaker dollar, okay, just because this one came in at a 3.7. So it's a possibility we could see a weaker dollar. and the yields is pushing lower. But if you take it, it might just end up being a scalp. Okay, so the red arrows might follow. But let me just read these comments real quick. So most likely, if we get weaker dollar, cool. But then the focus is going to be on the Fed's end operational limits on standing overnight repo operations. All right, so let me see if they said anything about growth. So weaker dollar is happening now. All right, so just to let you guys know, but just be cautious if you're taking it. I'm just holding my AUD USD trade. I'm not going to enter another position. All right, so inflation has moved up from earlier this year and remains somewhat elevated. So this is hawkish, right? So we got a hawkish comment. Let's do the dollar. I had the daily on the dollar. Yeah, yields are spiking lower, dollar is spiking lower. Okay. But yeah, they still said that inflation is still somewhat elevated. And tentative the risk on both sides of the dual mandate. So this is reacting right now to the dot plot. The operations, that's what it's reacting to. But so far, like forward guidance, signal rate cuts paused by adding extended timing to describe its approach and additional adjustments to policy rates. I have a feeling that the forward guidance is going to be hawkish. I don't recommend a trade. Wait until Jerome Powell speaks. Yeah, so right here, uncertainty about the outlook remains elevated. So he's saying inflation is still somewhat elevated. To me, this is hawkish. So I would probably wait until Jerome Powell. Because right now, these are algorithm spikes, just because of the cut. Yeah, data is still good. Exactly. Like so far, labor is still good. Inflation is still no massive changes. But this is just the algorithms. So right now, we got weaker dollar, but it's because of the cut, and then nobody really pays attention to the stuff that we're focusing on here, just to let you guys know. So when they see a rate cut, people are just selling the dollar and buying equities and don't really have an idea on why. They're just, rate cut, short the dollar. But the forward guidance is what matters. And so far, I don't really see anything that makes us more excited for additional rate cuts. Yeah, so we got inflation is still elevated. Yeah, we got here that downside risk to employment has risen. So we got weaker employment. Usually the Feds is focusing on weaker labor. So we got both. We got higher inflation expectations and then weaker employment. So kind of mixed. So the Q&A is going to be pretty exciting. So that should be exciting. So nothing here. So you can just tell by the moves. Like it looks big to you guys, but this is not something that shows a clear path, a clear direction. All right, so we got about 30 minutes. So we're going to have 30 minutes until Jerome Powell speaks so we can watch that together. Let me see about the repo. Bitcoin is falling. I mean, Bitcoin don't have. Well, I know it's traded against the dollar, but it don't really have not much to do with it. But I see why you guys look at it, but in reality, it don't really have much to do with it. Yeah, just be cautious, man. Like, just let it. Right now, gold is not really. We could see weaker dollar. We could, but I don't think it's worth a risk of a trade. Yeah, it is stagflation. It's a good question, Leo. I just think that they're trying. They don't want to have that wordplay because that's just going to cause. That would cause some shit if they like show recessionary fears. But yeah, like stagflation, that should be weak. It should be weaker for equities and for the dollar if that happens. If they make stagflation, obviously it is, but I don't think they're going to use that wordplay. But as of now, we got weaker dollar. Yeah, because I'm trying to look into the ending of the repo operations because that's good for the stock market. But I would expect that to be like longer term for it to be positive. But yeah, like so far, dovish reaction. But that, yeah, I would expect that to be good for the stock market, but a longer term perspective. But yeah, test. Yeah, so the ending of the repo operations, that's what helps the stock market. But I expect that to be long term. You know, not like right now. We see that the stock market hit all time highs, but this is a dovish reaction. Yeah, like weaker dollar, stronger equities. It's a dovish reaction. If you guys are in any trades, just be cautious of any like sort of pullbacks. 7 officials penciled in no rate cuts for 2026. Yeah, it's markets are forcing the cuts. Yeah, so that's why I think I'm I wouldn't be I'd be cautious if you guys are in like dollar sells and stuff. Like I'd be cautious because I feel like Powell is going to give more of a hawkish pause statement, and then we're going to be looking at reversals. But I feel like the end of the repo operations is what is this is the direction I expect for that is this. If they make that the priority, is right here. The ending of operational limits on standing overnight repo operations. This is good for the stock market. This is bad for the dollar also. So I think that's why like the yields, you can see that the yields is not plummeting, right? The yields is still a little like still a little supported, but the dollar and equities are pushing higher. I think that's just the algorithms from that comment. Yeah, I mean, like gold did spike higher, you know, but if I just zoom out of gold, it's just still in a overall choppy range. But it did break structure. You like you could take that trade if you took the break of structure, you got it to the high. That's a good take profit. Like I feel like that should be if you leave extra on the table, you just leave extra on the table. I would rather take profits just be cautious because this the impulse. The continuations is always hard to determine because there's nothing that I saw so far that would make me more confident in holding dollar weakness. You took buy Sparkle? Cool. Yeah, because you could get a 20, 30 pips easily, clean. No, not even no drawdown. But trying to hold on to it, that's the hard part because I didn't see anything to make us confident in it. Since I joined your course, almost in every FOMC after Paul's speech, it moves a lot and different size. First reactions on. Yeah, yeah, it's fine. Yeah, right now it's just a dovish reaction. Yeah, it's not. Yeah, gold does move quickly. That's the best one so far. Gold, dollar looks good. UJ is not good at all because the yields is not dropping, so it's not impacting the yen. So that's a good thing to stay away from that. Yeah, so that yeah, it's interesting because I want to see how farther they go with the ending of the repo operations because like just the simple terms, it just means that because they're not telling us why at the moment, but if they ended the operations because things are normal, right? So that means it's just less of a safety net for the stock markets. That like they're just pulling away the safety net. So if they're doing that because they feel like the conditions in the US is good, like no recessionary fears, that could be a reason to buy the stock market. Okay, just to make it make sense to you guys. So that's something that is important that was just said too. If they ended that just because, we have to see why, right? Like that would be if they ask him that in the Q&A, that would be good, and he explains why. And if he says like the conditions in the economy is still well, I think the stock markets would take that as a positive. Like so, he's saying like everything, they don't have to be Superman, right? They don't have to save the economy. They don't have to bail out anybody. Like things is running smooth. So if they're doing that because of that purpose, then that's different. All right. So that would definitely support the stock market. So that would be important for them if they ask him that question during the Q&A. They probably would, just to see like why they ended it, like why they ended it. That would be a good thing to focus on. Anybody else took the gold buy scalps, but yeah, this is what I mean. Is just going to deal with those pullbacks. We got 15 minutes. My YouTube is my name. It should be in a link in the bio. Yeah, that's interesting because if they ended made my daily 15% on gold, good job, Julio. If they ended the repo operations, right, because the banks don't need the help, that would go against everybody's expectations of recession, the bank fears, like lending problems. That goes against all of it. So that's actually them showing that the banking sectors are doing great. The economy doesn't need any help. So if they ended the operations because of things are good, then I know most of y'all don't want to hear it, but that makes Trump right. Make y'all pull your hair out because that's the only reason they end that, because having the operations flowing, it's the safety net that's giving them the extra liquidity, giving the banks handouts. So just to make you guys understand it, how can a beginner strategy using fundamentals to trade? You can join the group. Just join the private group. Everything is there to help you guys out. Yeah, so far dovish reaction, like, but just to show you guys, like, you see the red arrows is following, so that just shows it's a dovish reaction, that we got weaker dollar, because you see just this that one red right here, you know, so red arrows are following, so dovish reaction is weaker currencies, stronger equities, so that's what we got. But yeah, if this is why I created this for you guys, you know, so you get everything. This is the new course that I just did. This is from a macro perspective, though, like a macro perspective, just so you guys could learn how to understand swing trades. So you could understand swing trades, like why institutions hold trades a lot longer, like how they get in 3 to 6 months in advance, right? So you could just get to see the bigger picture. You get to understand the cycles. So each module breaks everything down, you know, all the way. There's about, I'm gonna have to finish these 2 modules, but overall there's 10 modules breaking everything down on understanding credit, how the economy is being run by credit, understand the yield curve. You can learn about how they anticipate recessions. So you're going to learn all of this stuff because the markets is ran by money and credit, right? So they pay attention to all of this stuff. Learn about central banks, risk on, risk off. And plus I have even more that I did in the past. So you can just see there's like 16, 20 lessons, and you can see how long these courses are. So everything that you need, like, and it's all beginner friendly as well to advance. So everything is here that you need. And I believe I have, like, for beginners too. Yeah, right here is for beginners. So like what is Forex and all this stuff. So you have everything here. You know, this is all included in the membership. But if you don't want to join the private group and you just want the course yourself, then just press the link of the course. But it's all included in the private group. The least I could do. So when I join the live calls, it makes it easier to understand. But at the end of the day, you know, like, you still have to learn how to apply it. So you can learn all of it, but then don't know how to apply it. So that's why joining the live calls and be present for the market updates is important. Yeah, like, we're going to wait for Jerome Powell. We got time. We got time. Yeah, so we're going to look at the tie he's going to wear. Like, if he red tie, sell the stock market, green tie, blue tie, you're going to buy. Yeah, something like this.
Good afternoon.
It'd be like that sometimes. Like, depends on how, like, good afternoon, buy. Good morning, sell. Like, it'd be like that sometimes. Just got to pay attention to everything that he says. I don't know which one is going to be better. Probably
It would certainly add a lot more stimulus to what we're already seeing, and stimulus is heat. Heat is inflation, unless you can really get all those offsets from AI in the right places. And I think that's the...
Yeah, so you can see, like, this is why, like, paying attention to... I know most of you guys don't like it, it's boring. But if you're trying to understand the language, that's why it's important to, like, listen to, like, Bloomberg is a good choice.
immigrants have
So
dominated.
you could
That's
get
shown
a
up
really
in
good
places as well,
understanding of
in
like
home
what's
healthcare,
important, right? So
childcare costs,
remember what I said.
soaring.
He said that
was just in
employment is
September,
lower,
and those
right? He's
shortages
expecting more
have only gotten
downside
worse
risk to
since
employment.
then.
So that's dovish. They focus on the labor markets. So that is going to be, you see how they make it breaking news. So that is kind of what they focus on. You know, that's what they put out to the media. That's how they do it. Oh, everybody pay attention. Like the labor markets are dropping. So they do a lot of fear mongering, but they also consider that inflation is still high, and inflation is still above their target range. Their target range is between 2 to 2.5%, right? So if inflation is not lower than that, they also still going to show caution when it comes to because of high inflation. Yeah, you have it 5 days a week. Yeah, and it's free. Yeah, exactly. That's what I do also in a private group. Like I leave the Bloomberg, like the news feed, like here. So you're able to look at the Reuters news headlines, Bloomberg, and economic data in the background. And I just have that in one of my monitors running 24/7. So I'm never missing a news headline. And then all my notifications on my phone is news headlines. Am I reading here that the Fed will launch QE in 12? Yeah, like that's the next step of the cycle, you know? So that's where I try to teach you guys, you know, about there's a cycle. I don't know if you guys read or listened to Ray Dalio, but there's a cycle that goes around 24/7. There's always, not 24/7, but there's always a cycle. We got the short-term cycle and the long-term cycle. So after quantitative, they ended QT, they ended it December 1st, right? So usually QE, they need a reason to do QE. They need a reason. So this is where we have to worry, because when they have a reason, that means they have to force some sort of a recession, right? So something bad has to happen in order for them to do quantitative easing. They just can't do it just to do it. It has to be some sort of a reset. So that's where the transfer of wealth comes in place. So you get it? So they just can't do it just to do it. So something bad has to be happening in order for them to do it. So that's what we pay attention to, is the transfer of wealth. You know, so if they do that, then most likely something is going to occur first. We just don't know what it's going to be. I'm probably not even going to get monetized because I'm showing this YouTube thing right here. Fuck it, I don't care. You see gold hitting. It's a possibility. It depends on what happens now.
About that, and I think it's more coming from the global sphere at this point.
Let me know if you guys could hear this on
places like the RBA,
YouTube.
Turn a little bit more hawkish. There's questions about the ECB, Bank of Canada. They're seeing stronger economic data as of late. For the Fed specifically, though, I think you need two things to happen. One, you have to have a clear elimination of downside
Could
risks
y'all hear
to the
that?
labor market. We are not there yet. There's still some fragility in this labor market over the next several months. You know, perhaps by the end of next year, we could get there. And two, you need the labor market to return as a source of inflationary pressure. So you need
private group, you can hear
the
it, or
unemployment
y'all
rate to
can't.
decline, quits rate to move higher, and wage growth to accelerate.
Low?
I think it's possible. I think you are seeing a substantial, reduction in labor supply in the U.S. economy. I think if you were to add on even more fiscal stimulus, so if we were to get these $2,000
is that better,
stimulus
Julio?
checks from the Trump administration, I think that's the type of dynamic where that could really shift the debate. People
Soft,
would begin to
let me
think a little bit more actively about rate cuts in the U.S. But to be clear, I don't think we are there. Our baseline expectation is the next move is a cut.
How's that?
Bob, what do you think? What do you think it would take for the Fed's next move or a move next year to be a rate hike and not a cut?
Well,
Yeah, 'cause I just
want
wanna make sure, like, on YouTube, it's
fiscal
not, like,
stimulus
double
from the One
the
Big
volume.
Beautiful Bill Act hit and accelerate business investment and consumer spending. You'd have to see a labor shortage resulting from that, and you'd have to see a wage price spiral. Maybe you'll see that in the second quarter, but right now the Fed threaded the needle. Can't we just enjoy this into the holiday
Come on,
season?
you
All right,
know
I just
us.
do it like that.
That's the smartest thing I've heard today. That's the smartest thing I've heard. And Powell's a pinata. I get that.
What
but
video
the bottom
live is
line
this? I don't know what you're talking about.
We
What do
have
you
a
mean?
prosperous economy for the haves. Let's not upset that apple cart while everyone, well-meaning, tries to help people that are struggling so much. I mean, that's threading the needle right now.
I
is
forgot
we're
what was
doing.
today. Let me
Well,
see.
yes, but let's
should be.
not
I
forget
should
that
be
the
home
One
for
Big
it.
Beautiful
Let me see.
Bill Act also has no taxes on tips, overtime, Social Security payments.
Right.
A lot of those are concentrated in the bottom couple quintiles of earners. So there
Unemployment?
should
Yeah,
be
if it's unemployment,
some
yeah, we can look at
relief
that.
coming there.
But yeah, it's
Where's
hard to
your lack of
trade
conviction? Matt
AUD.
Lazzetti on an outlook and off of this Fed meeting today.
Like if it's not like inflation,
Where's
because the
question of your
timing
conviction
is
into-
like really.
I had a crazy idea. We were surprised that no one had done it before.
Yeah, 6:30. Like that's the problem is 6:30. You know, so it's not going to be, the volume sucks at that time. But like we could focus on it. If it's like a massive miss, then yeah, like we could manage it, but it has to be a massive number. Like they're expecting unemployment to be worse than expected. So I'm obviously, when it comes to the comments below, will Jerome Powell stay stagflation? So you're not alone, Leo. Like this I'm not gonna say that name, but you can see like the kid right here. He's saying lower inflation. If they see stagflation, that'd be crazy. I think he would never. I don't think he'll ever say that, but that's a possibility. But yeah, go back to AUD. It's at 6:30, so it's not a lot of volume at that time. But we did have weaker GDP. But so if this one does come in lower than expected, I would most likely get out my AUD USD trade. I would get out of it. I'm looking to get out of it now, actually, because I feel like he is going to give us more of a hawkish pause today. So I feel like getting out of that trade and probably just looking at UJ for the time being, because I have a feeling he's probably going to say something that gives us a hawkish pause.
And the data we're going to get early next year in that assessment. But I'd like to get confirmation of that from the chair today.
Matt Lazzetti, thank you as always for your time, and I look forward to hearing what you think after the Fed conference. This is an important point. How much is this, in some ways, forecasting that December 16th jobs report that we should have already had? It should have been the sort of 1-2 punch where last Friday we got the November jobs report. They took that data into hand, and then this meeting, they responded to it. Bob?
Yeah, I think you can go back to September and say this is another risk management adjustment to
Bloomberg
policy,
right here. Yeah,
that
Bloomberg.
there are some signs of a soft labor market.
Stagflation,
You're far away
it
from what you're
depends. Like,
forecasting
I think
as your
regardless,
neutral
if
rate.
stagflation
Why not take
is
another 25 basis
what they
points
anticipate
off
or
of
say,
that?
We should see dollar and equities probably push lower. Yeah, like I feel like that could probably, it would cause mixed reactions for the dollar. But if it's a stagflation, I think everything is going to go red, you know, just from the fear alone. But equities should push lower from that. Like most definitely, we should see equities push lower from that. Yeah, it's Bloomberg. It's Bloomberg. Yeah, but how do you join? Just go to my bio and my link. Blessings. Can you share the sites where everything is in my link? Yeah, let's see what we get when he comes to. Yeah, the tie is the giveaway. Yeah, he wears some weird shit. Like, there was one meeting, if he don't have his glasses on, then you know something is up. Like, you could just tell that something is up. But this is his last rate decision. So it's going to be interesting to see how this goes. This is his last one, you know? Like, he could just, like, F this, F that. Like, it'll be crazy. But is it January? Yeah, it's January. Yeah, January. Yeah. Never mind. Yeah, he does January. And I believe we have one in March. I don't know about, well, when is his last day? Yeah, my colleagues and I. May? Okay, so yeah, all right. So next year is the last one. All right, so he might play the ball for here. It just depends on like what he does after, you know, like what do you do after? You've been a Fed chair for so long. It's like obviously if he wants to keep working, you know, he has to play ball a bit. Like, look at the yields. Like, yeah, the yields. Yeah, let's see what the yields is the giveaway. If you can't see it, just get the US 10 yield. Usually that's the giveaway, is the yields. That kind of tells you where they're expecting interest rates to go. So if the yields are pushing lower, most likely means dollar is going to weaken. If the yields are higher, you expect a stronger dollar. All right, so he's supposed to start. All right.
Achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Although important federal government data for the past couple of months have yet to be released,
silver should follow
available
gold.
public and private sector data suggests that the outlook for employment and inflation has not changed as much since our meeting in October. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. Lower our policy interest rate by a 1/4 percentage point. As a separate matter, we also decided to initiate purchases of shorter-term Treasury securities solely for the purpose of maintaining an ample supply of reserves over time, thus supporting effective control of our policy rate. I will have more to say about monetary policy and its implementation after briefly reviewing economic developments. Although some key government data have yet to be released, available indicators suggest that economic activity has been expanding at a moderate pace. Consumer spending appears to have remained solid, and business fixed investment has continued to expand. In contrast, activity in the housing sector remains weak. The temporary shutdown of the federal government has likely weighed on economic activity in the current quarter, but these effects should be mostly offset by higher growth next quarter, reflecting the reopening. In our summary of economic projections, the median participant projects that real GDP will rise 1.7% this year and 2.3% next year.
He just
somewhat stronger
rereading
than projected
pretty much
in September.
everything that we know so far, but
in the
pretty
labor market,
neutral
although
slash
official
hawkish.
employment data for October and November are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms'
But most likely,
perceptions
why
of hiring
equities is
difficulty
doing this is
continue
because
to
he's
decline.
saying stronger growth, stronger
The
labor
official
markets.
report
That
on the labor
supports the
market for
stock
September,
market.
the most recent release, showed that the unemployment rate continued to edge up, reaching 4.4%, and that job gains had slowed significantly since earlier in the year. A good part of the slowing
So that's
likely reflects
dovish.
a
Saying the
decline
labor
in the
markets is
growth of the
clearly
labor force
slowing, that's
due
dovish.
to lower
So that's what's
immigration and
helping
labor force
dollar push
participation.
lower, equities is
Though
pushing
labor
higher.
demand has clearly softened as well. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months.
See,
In our
more,
SEP, the median
he's saying that
projection
the
of the
downside
unemployment
risk
rate is
has
4.5%
risen, so
at
that's
the end of this
dovish.
year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Very little data on inflation have been released since our meeting in October. Total PCE prices rose 2.8% over the 12 months ending in September.
All right. So he also explained that inflation
Energy
is still elevated. So that's where it goes against each other. But if he's saying that, if he says like inflation is temporary higher, the dovish reaction we're getting now with weaker dollar, stronger equity should continue. So right now, the markets is reacting to the comments of saying that labor demand has slowing. So this is why we got weaker dollar and stronger equities right now. So also still follow the yields. We need the yield to start breaking lower.
Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.9% this year and 2.4% next year, a bit lower than the median projection in September. Thereafter, the median falls to 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a 1/4 percentage point to 3.5 to 3.75%.
Yeah, you're welcome.
In the near
So
term,
just wait for the
risks to
Q&A. The
inflation are
Q&As
tilted to the
usually give
upside,
the upper
and
hand.
risks to employment
He's just
to the
repeating
downside,
everything that we
a
read
challenging
already.
situation. there is no risk-free path for policy as we navigate this tension between our employment and inflation goals. A reasonable base case is that the effects of tariffs on inflation will be relatively short-lived, effectively a one-time shift in the price level. Our obligation is to make sure that a one-time increase in the price level does not become an ongoing inflation problem.
So that right there is the giveaway.
But with
that
downside
inflation
risks
is
to employment
because he
having
blames
risen in
inflation
recent
on
months,
tariffs.
the balance of risks
But he's
has
saying
shifted.
that is a one-off risk.
Our framework calls
to me,
for us
that's
to take a
dovish.
balanced approach in
Just
promoting
saying that
both sides
inflation
of our
is
dual
higher
mandate.
and it's temporary,
Accordingly,
pretty much.
we judged it appropriate at this meeting to lower our policy rate by a 1/4 percentage point. With today's decision, we have lowered our policy rate 3/4 of a percentage point over our last 3 meetings. This further normalization of our policy stance should help stabilize the labor market while allowing inflation to resume its downward trend toward 2% once the effects of tariffs have passed through. The adjustments to our policy stance since September bring it within a range of plausible estimates of neutral and leave us well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks.
He sounds like they're not cutting interest rates next
In our
year.
summary of
That's what it
economic
sounds like.
projections,
So just
FOMC
be
participants
cautious.
wrote down their individual
So
assessments
the Q&A is what's
of
going
an
to be
appropriate
important,
path
but
of the
it
federal
sounds
funds
like
rate
he is not
under
looking to
what
cut
each
interest rates
participant
next year.
judges to be the most likely
So
scenario
just be
for the
cautious of
economy.
that. All right, guys?
The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the
I'm
end
gonna close
of
out of my
2026,
AUD. Fuck that.
and
I'm gonna close my
3.1% at the end
AUD
of
USD buys
2027,
because he sounds like
unchanged
he is
from
not
September.
cutting interest rates next year.
As is always the case, these
So I
individual
am not
forecasts are
gonna
subject to
mess up
uncertainty,
my
and they're
15K.
not a committee plan or decision. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis. Let me turn now to issues related to the implementation of monetary policy, with the reminder that these issues
Yeah, I
are
ain't messing
separate
with
from
that.
and have no implications
I will see what
the stance
the
of
Q&A
monetary
says.
policy.
Like, obviously,
In light of the continued tightening in money market interest rates
All right, let's see what he
relative to
says
our
here.
administered rates and other indicators of reserve market conditions, the committee judged that reserve balances have declined to ample levels. Accordingly, at today's meeting, the committee decided to initiate purchases of shorter-term Treasury securities, mainly Treasury bills, for the sole purpose of maintaining an ample supply of reserves over time. Such increases in our securities holdings ensure that the federal funds rate remains within its target range and are necessary because the growth of the economy leads to rising demand over time for our liabilities, including currency and reserves. As detailed in a statement released today by the Federal Reserve Bank of New York, reserve management purchases will amount to $40 billion in the first month and may remain elevated for a few months to alleviate expected near-term pressures in money markets. Thereafter, we expect the size of reserve management purchases to decline, though the actual pace will depend on market conditions. In our implementation framework, an ample supply of reserves means that the federal funds rate and other short-term interest rates are primarily controlled by the setting of our administered rates, rather than day-to-day discretionary interventions in money markets. In this regime, standing repurchase agreement, or repo operations, are a critical tool to ensure that the federal funds rate remains within its target range, even on days of elevated pressures in money markets. Consistent with this view, the committee eliminated the aggregate limit on standing repo operations. These operations are intended to support monetary policy implementation and smooth market functioning and should be used when economically sensible. To conclude, the Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing our inflation sustainably down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success
all
in
right,
delivering
so just
on these
focus on the
goals-
Q&A. Like, usually, like, the first 5 questions is important. Like, overall, like, we still got a dovish reaction because he's talking down on the labor markets. He's expecting that the labor markets is going to get worse. So usually that is the focus of the economy, pretty much, is how good or bad the labor markets are. So that's why we had weaker dollar, stronger equities. But we want to focus on inflation and future rates. So let's see what the Q&A says.
Just first turning to the statement, just to be clear, we're on the same page here. The insertion of the phrase, considering the extent and timing of additional adjustments, does that indicate that the Fed is now on hold until there's some clearer signal from inflation or jobs or the evolution of
Let's
the
see what
economy
he says,
along
'cause
the
that's gonna be the
baseline
move.
outlook.
So, yes, the adjustments since September bring our policy within a broad range of estimates of neutral. And as we noted in our statement today, we are well positioned to determine the extent and timing of additional adjustments based on the incoming data, the evolving outlook, and the balance of risks. That new language points out that we'll carefully evaluate that incoming data. And also,
You see,
I would note
he's
that
more
having reduced our
hawkish.
policy rate
They're
by
going to probably
75
buy the hell out the
basis points
dollar and
since
sell
September,
equity markets.
and
Let's see
175
how it
basis
goes,
points
but
since last
he's not
September.
confirming future
Fed
rate
funds
cuts.
rate is now within a broad range of
For now.
estimates of its neutral value, and we are well positioned to wait to see how the economy evolves.
Wait to see.
And
So
if I could
that's
follow
more
up on the outlook
hawkish.
there, it seems like with the additional GDP growth coupled with easing inflation and a fairly steady unemployment rate.
So we're going to
this
see
seems
the
like a
green
pretty
arrows.
optimistic
Like equities
outlook,
should push a
for
little
next
lower,
year.
but dollar.
What's
Let's see if the
given
dollar
rise to
starts
that? Is
gaining
this an
strength.
early
Now we
bet
want
on
him to
AI?
stay
Is there
that
some
tone
sense of,
for the rest of the
improving
Q&A.
productivity
If
out
he
there? What's
confirms they
driving
being
that?
data dependent
So a number of
and
things are
being
driving,
patient, the market's
what's
going to
happening
start
in the
pricing
forecast.
in
And I would say if
that
you-
they're
if you
not
look
going to cut
broadly at
rates.
outside
So this is
forecasts,
why
you do
gold is
see
pushing
a
lower,
pickup in growth
and now
in
we're
many
going to
of
see
those now,
dollar
too.
and
So
equities push.
it is,
Dollar
it's
is going to
partly
push
that
higher.
consumer spending
Equities
has
might
held
push
up.
lower too.
It's been resilient, and it to another degree, it is
Gold
that
sells. Good job, Israel.
AI spending on data centers and related to AI
Now,
has
like
been
obviously
holding
it could
up
be
business
whipsaw.
investment.
So let's make
So
sure
overall,
he stays this
the
language because he
baseline
could change his
expectation for
tone
next
in
year
the
is,
next
at
question.
least
He's
at
good
the
at that.
Fed, and I think
So just be
with outside
cautious of it.
forecasters
All
too,
right.
is
So
a pickup in growth from
this
today's
is
relatively
this
low
should
level of
signal
1.7%. I mentioned
markets should start
that
pricing
the SEP
in
meeting
more
is
rate
1.7
pauses,
for this year,
right?
growth,
Pauses
and
of interest
2.3
rates
for
next year.
You actually,
But he needs to
some
stay.
of that
It's
is
just
due
this is just
to
the first Q&A. This is
shutdown.
the
So
first
you can
question.
take
So the
0.2
markets
out
could
of
still now
2026
the algorithms
and put it
has
in
to price that in.
2025, so it
Okay?
would really be 1.9 and 2.1.
Like I don't like the sells
But
on
overall,
equities
yes,
for now because he's confirming. You see, consumer spending is still high, growth is still doing well. So any pullbacks in the stock market, right, that could lead to better buys later on. So just be cautious when it comes to the equity markets, but this should give us a hawkish reaction. But let's see how aggressive, the dollar and the yields are going to go because of it. Okay, so if he stays this route, then great. Like that would be a great trade for the rest of the day.
Ford was asking, is the risk management phase of rate cuts over here? And have you taken out sufficient insurance, I guess, against potential weakness in terms of the data we might get next week when it comes to employment?
So we're going to get a great deal of data between now and the January meeting, and I'm sure we'll talk more about that.
Yeah, I had
And
a
that
shitty
will-
entry on
the data
UJ,
that we
but
get are
I'm in
going
profit
to
at least.
factor into our thinking. But yes, we have. If you go back, we held our policy rate at 5.4% for more than a year because inflation was high, very high, and unemployment in the labor market was really solid at that point. So what happened is over last summer of 24, inflation came down, and the labor market began to show real signs of weakness. And so we decided, as our framework tells us to do, that when the
Sorry if he
risks to the
stays
two
hawkish.
goals become
What
more
about
equal,
crypto if he
you should
stays
move
dovish?
from
I mean, usually
a
crypto
stance that
likes
favors
it
really
usually
dealing
follows
with one of
gold.
them,
I'm
in
not
that case,
sure what
inflation,
crypto is
to
doing.
a more balanced,
but-
more neutral
Yeah, let's see.
setting. And
my
so we
use isn't triggered
did
yet.
that. We did some cutting.
Yeah, we
and
still
then
got
we
time,
paused for a
but
while
so
to
far he's hawkish.
work our way through
Let's see
what
if
was
he
happening in the
continues
middle of
that
the year.
language.
And then we resumed cuts in September.
But remember,
we cut
when
now
it comes
three.
to
We now cut a
equities,
total of
like it's not a good, like a massive sell on the stock market because growth is still good. The confidence is still there. So we could possibly see a little recovery in the stock market, right? If we do get equities to push lower, that'd be great. You could capitalize on those sells, but watch out for the reversals. Dollar, I would like to see the dollar, I would love to see the dollar go above 100. And I think that would be great for gold sells if that plays out. But this is just the first Q&A. So just be cautious.
And the implication is obviously higher productivity. And some of that may
be
be
prepared
AI.
for Trump's
also,
tweets.
I think productivity has
Trump
just
is
been
pissed, so
almost
you already
structurally
know.
higher for several years now. So if you start thinking of it as 2% per year, you can sustain higher growth without more job creation. Of course, higher productivity is also what enables incomes to rise over long periods of time. So it's basically a good thing. But that
Looks
may
like
be,
Bitcoin
that's
is not
certainly
doing
the implication.
anything as of yet. there's no real movement yet. So let's wait and see.
Thank you. Colby Smith with the New York
So it
Times.
has nothing to
Today's
do with
decision
the
was clearly
currencies.
very divided. It wasn't just the two official dissents against a cut, but there were also soft dissents from 4 others. And I'm just wondering if this reluctance from several people to support recent reductions suggests that there is a much higher bar for cuts in the near term. And what exactly does the committee need to see if things are well positioned right now to support a January reduction?
Sure. So let me just say, as I mentioned, and as I've mentioned here before, the situation is that our two goals are a bit in tension, right? So interestingly, everyone around the table at the FOMC agrees that inflation is too high and that we want it to come down, and agrees that the labor market has softened and that there's further risk. Everyone agrees on that. Where the difference is how do you weight those risks? And what does your forecast look like?
All the Fed members are divided.
Ultimately, where do you think the bigger risk is? And you know, it's very unusual to have persistent tension between the two parts of the mandate. And when you do, this is what you see. And I think it's actually what you would expect to see, and we do see it. Meanwhile, the discussions we have are as good as any we've had in my 14 years at the Fed. They're very thoughtful, respectful, and you just have people who have strong views. And you know, we come together and we reach you know, a place where we can.
Yeah,
make
this is just him saying a whole lot of nothing.
You know,
so far we already got the expectations that there's not going to be no hikes, no cuts next year. Those are the expectations. So I still like to see a hawkish reaction, but it'll be great if they try to continue to pressure him with that type of questioning so that he could just repeat it. You know, so that would be let's see.
I mean, cut 75, and you know the effects of the 75 basis points will only begin to be coming in. As I've said before a couple of times, we're well positioned to wait to see how the economy evolves. We'll just have to see. And we will get, as you know, quite a bit of data. I should mention on the data, as long as I'm talking about it, that we're going to need to be careful in assessing, particularly the household survey data. There are very technical reasons about the way data are collected in some of these measures, both in inflation and in labor. In the labor market, so that the data may be distorted and not just sort of more volatile, but distorted, and that's really because data was not collected in October and half of November. So we're going to get data, but we're going to have to look at it carefully and with a somewhat skeptical eye by the time of the January meeting. Notwithstanding that, we will have a lot of the December data by the time of the January meeting. So we expect to see a lot more, but I'm just saying that what we get for example, CPI or for the
so that means no
survey,
vacation break when data come out.
We're going to look at that really carefully and understand that it may be distorted by very technical factors.
And just one more question on dissents. I mean, you talk about it in a very positive way, just given the complicated nature of the situation we're in economically. But is there any point in which those dissents become counterproductive, either to the Fed's communication and the messaging around?
Yeah, like this is what I don't like when the reporters be asking shit like this. It's like you need to put a black person up there to pressure him or something.
Again, these are good, thoughtful, respectful
these people
discussions.
Don't even try
and
to get him to say
you hear people
something.
say, and you hear many
yeah,
outside
it's like
analysts say the
irrelevant
same
as
thing.
hell.
I could make a case for either.
Shit is crazy.
For either side.
They need to put somebody
I
up
could
there
make
with
that
balls.
case. It's a close call. We have to make decisions.
That's what makes me believe these Q&As are like
the data will give us a clear read.
Because it's
in this situation, you have
all know
competing.
what we want to hear.
If you look through the SEP, you'll see that a very large number of participants agree that risks are to the upside for unemployment and to the upside for inflation. So what do? You've got one tool. You can't do two things at once. So at what pace do you move? What size moves do you make, and that kind of thing? And what's the timing of them? It's a very challenging situation. I think we're in a good place to, as I mentioned, to wait and see how the economy evolves.
Probably like the third Q&A. Hopefully we get something in about 2 more Q&As. If not, then
Nick Timmeroso, The Wall Street Journal.
I would expect a hawkish reaction to hold.
There's been some discussion recently of the 1990s. In the 1990s, the committee did 2 discrete sequences of 3 quarter-point cuts, one in 1995-96 and one in 1998. And after both of those, the next move in rates was up, not down. With policy now closer to neutral, is it a foregone conclusion that the next move in rates is down, or should we think of policy risks as genuinely two-sided from here?
So I don't think that a rate hike is anybody's base case at this point, and I'm not hearing that. What you see is some people feel we should stop here, and
I mean, that's a stupid question, but
some
you know
people
they're
feel
not
like
going to hike
once
interest rates
or
because
more.
the debt in the United States is at all-time
when people
highs.
are writing
They
down
can't hike
their
interest
estimates
rates.
of policy,
That's
where
just
it
a
should go,
stupid ass
it
question.
is either
like,
holding
and then
here or
people look up to these
cutting a
dudes,
little or
right?
cutting
Like,
more than a little.
oh, they
So
got
I
a
don't see
degree,
that as- I don't
but
see
that's
the
just
base
like
case
that
as
just shows,
involving
you know, like
that. So of course,
what kind of question
a
is
data
that?
set of 2 now 3 is not a
But
big
now
data
the
set,
markets,
but
the
you
dollar
are
could
right
push
about those
lower
2,
because.
3 cut.
But this is what I mean, like algorithms, Leo, is because now the algorithms could push the dollar lower because he says that we're not thinking about a rate hike. So just that key word could push the dollar lower. But it's not
What gives you
something that we
confidence it
don't
won't
know.
continue
You know what I'm
rising in
saying?
2026,
So this is what messes up the
especially when
trades. This
housing
is
and
like
other
the
rate-sensitive
algorithm spikes with the
sectors
keywords.
still appear to be feeling restrictive policy from the, notwithstanding the 150 basis points in cuts prior to today.
So I think the idea is that with now having cut 75 basis points more now and having policy,
Yeah,
you know,
see the
call it
dollar
a broad
pulled back, and
range
now
of-
this is good for
of
equities.
plausible
Exactly,
estimates of neutral.
because this is
But
just
that
the
will be a
like
place
you just
which will
confirming what we
enable the
knew
labor
for
market
about
to
3 years
stabilize
that
or
they're not going
to
to hike
only
interest
tick up
rates,
1 or
and
2
then
more
now
tenths.
we see the
We
dollar
won't
push higher.
see,
It's like they
you know,
already know that, so
any
you
kind
can
of
tell
sharper
this is just
downturn, which we haven't
algorithms.
seen any evidence of at all. At the same time, policy is still in a place where it's not accommodative, and we feel like we have made progress this year in non-tariff related inflation, and as tariffs come through, as they flow through, that'll show through next year. But as I said, we're well placed to wait and see how that turns out. That is our expectation, but you know, we're going to start to see the data, and it'll tell us whether we were right or not.
Claire Jones, Financial Times. A lot of people interpreted your comments at the October meeting that, you know, when there's a foggy situation, we slow down, to mean that, you know, there wouldn't be a cut now, there'd be a cut in January instead. So it'd be good to get a sense of why did the committee decide to move today rather than to move in January instead? Thank you.
Right. So in October, I said that there was no certainty of moving, and that was indeed correct. I said it's possible you could think about it that way, but I was careful to say other people could look at it differently. So why did we move today? You know, I would say point to a couple things. First of all, gradual cooling in the labor market has continued. Unemployment is now up 0.3 from June through September. Payroll jobs averaging 40,000 per month since April. We think there's an overstatement in these numbers by about 60,000, so that would be negative 20,000 per month.
So at the end of the day, Dovish,
and
yeah,
also,
like
just
I
to
feel
point
like
out one other
when
thing,
he said that
surveys of
there's no more hikes,
declining supply and
that
demand for
kind of
workers.
gave the Dovish reaction.
So I think you can say that
it's
the
what
labor
I didn't
market
like that
has,
question because we already know
continued
that.
to
But
cool gradually,
in the current
maybe
moment,
just
while
a
he
touch
says
more gradually
that
than we
gives a
thought.
reason for equities to push
you know,
higher
in terms
because
of
he's
inflation,
confirming no more rate hikes, and then that
it's come in a
causes
touch
dollar to push lower. So the
and I
wordplay
think the evidence
is what's messed up
is
because it kind of ruins what
growing
we're focusing
that
on now,
what's happening
which
here
is like what's going to
services
happen in
inflation
January. So he's like,
coming
well, we're
down,
not going to hike rates, so we
and
don't have to worry about
that's
that.
offset by
so this is
increases
supportive for
in
the stock
in
market.
goods.
So this is
and
what's
that
going
goods
on.
inflation is entirely
But
in sectors
like
where
it doesn't
there are
change the
tariffs.
bigger
So
picture. He's talking
that
about
does
the labor
build on
markets
the
is
story,
cooling.
and so far
so
it's only a story.
That alone
this
would
is
signal
the goods
that the
inflation,
markets
which is
will
really the source of the
continue,
excess
like
at this.
the markets is going to price in cuts anyway because the labor markets is cooling, and he's confirming that. So when you guys go through the course, you're going to see like as if the labor markets is still pushing lower, that means inflation eventually will drop anyway. So that's why they're focusing on the labor markets, because us as consumers, we drive the whole economy. So if we're not working, we can't pay for goods. We can't pay for goods. Businesses is going to have no choice but to lower price. Exactly. Less money. So as long as the labor markets is still showing easing, which he's saying, well, we still see stress in the labor markets, unemployment is rising, the markets is going to still preset rate cuts anyway, because the labor markets is getting worse and worse. So as long as that the labor market scenario is still bad, that's what they're focusing on. Because even if he says like, oh, higher inflation is temporary, or we still think inflation is high, we know just by understanding how the economy works, if the labor markets is still dropping, inflation is going to drop anyway. You know, if right now he says it doesn't feel like a hot economy. So if he says that, we already know eventually inflation is going to come down. So the markets were already preset. Well, they're going to cut rates anyway. So that's why, like, he could say one thing, but the markets will react differently. And that's what's going on right now. But what started it was that question about rate hikes. Oh, we're not going to hike rates. Like, we already know that, you know, but the fact that he said it now, he's confirming it in front of the whole world. We're not hiking rates. This is what gives us the dovish reaction. All right. Because I wouldn't expect that to be a question, because we already know that. But the fact that he said that to the whole world, if you was a hedge fund manager with billions of dollars, right, invested, if you know for certainty the Federal Reserve is not going to hike interest rates and he says it in front of you, why wouldn't you buy the S&P 500? So that's what's going on right now. So we are getting that dovish reaction because he confirmed no rate hikes. But what we need to focus on is what's going to happen next year. So he's not confirming next year we're going to get rate cuts. So that's the problem. So right now it's just, I feel like this is just an algorithm move. The fact that he said that there is no rate hikes. So that is causing dollar weakness and upside in gold and equities right now. And then he's confirming the weakness of the labor markets. So he's saying all of this stuff, you know, but it depends if the markets still expect him to cut rates next year. So that's what's going to happen after all of this finished. Then we're going to see how the markets act. Then after this, we're going to focus on labor data. Like, remember the 16th. So next week, we're going to get NFP data. Then we're going to focus on inflation data. So the weaker labor data is, we're going to expect weaker dollar. Like I said, overall, rate cuts is going to happen anyway. It just depends on how long is it going to take for the Feds to get to their target range of 2 to 2.5%. How long it's going to take. So that's what matters the most.
This is the last post-FOMC press conference before an important Supreme Court hearing next month. Can you talk about how you're hoping the Supreme Court will rule? And I'm just curious why the Fed's been so reticent on such a pivotal matter.
It's not something I want to address here, Andrew. You know, we're not legal commentators. It's before the courts, and we think we don't think that we help matters by trying to engage as a public discussant of that. I'll give you a mulligan, though.
No, thanks. I don't know if that means I get 3 questions, but
no, just one more.
I guess I wanted to come back to the 1990s question, and like, do you see that as a useful model for thinking about what is happening in the economy right now?
I don't think it rises to that level. So I did think that in 2019, where we cut 3 times, but you know, this is such a unique situation. It's not the 1970s, let's put it that way, but we do have tension between our 2 goals. And so that's just unique in my time at the Fed, and I think going back a long ways, we haven't had that. In our framework, as you know, says that when that's the case, that we try to, you know, take a balanced approach to the 2 things, and we look at how far they are and how long it would take to get them back to each of them back to the goal. And that's a very subjective analysis, really, but it just tells you you've got to. And I think ultimately what it says is when they're broadly equally threatened or equally at risk, you should be kind of neutral, because if you're either accommodative or tight, you're favoring one or the other goal. And so we've been sort of moving in the direction of neutral. Now we're in the range of neutral. We're in the high end of the range of neutral, I would say, and that's what we're doing now. It so happened that we've cut 3 times. That, you know, we haven't made any decision about January, but as I've said, we think we're well positioned to wait and see how the economy performs.
Edward. Thanks, Mr. Chairman. Edward Lawrence with Fox Business. I wanted to ask you, the inflation expectations has come down
it's because
in your S&P report.
The reason why is a government problem, but it makes it harder for the government to pay back its debt to the Federal Reserve. That's why. Even though that the feds don't really care, it's not their job to focus on the government, but it makes it harder for the government to pay back its debt.
And then it takes some months. Goods may have to be shipped from other parts of the, it may take, quite a while for an individual tariff to take its full effect. But once it's had that effect, then the question is, isn't that just a one-time price increase? So we actually look at it, all of the announcements and what you get from all that. You see sort of for each one of them, there's a time period, and then it's fully in. So if there are no new tariff announcements, and we don't know that, but let's assume there are no major new tariff announcements, inflation from goods should peak in the first quarter or so,
Yeah,
right?
let's
Or
see what the
roughly,
markets do
we
now.
haven't been
It's
able to
3,
predict this
and
with
we're
any
gonna focus
precision.
on,
No one is. But call it the
yeah, you
first
still hold
quarter
AU, good
or
job.
so
Like,
of next
I
year
don't-
should be the peak.
Personally,
And
I don't
from
like.
here, it should be.
I
it shouldn't be
understand why dollar and equities did what it did right now, but I don't think this is long term. So I understand why it happened. It was the comments that I mentioned earlier, but is it longer term like that? I don't expect it to. But we'll watch equities, like, just in case if we see some pullbacks. Like, it's late in the session now, it's at 3. I personally don't think he's going to say anything else but repeat itself. Let's see what he
No
says here.
mulligans for it. Michael McKee from Bloomberg Radio and Television. 10-year rates are 50 basis points higher than when you started cutting back in September of 2024, and the yield curve basically has been steepening. Why do you think that continuing to cut now, especially in the absence of data, is going to bring down the yield on the thing that will move the economy the most?
So we're looking at the real economy and focusing on that. And you've got when the long bonds move around, you've got to look at why they're moving around. If you look at inflation compensation, it's very that's one part of it is inflation compensation break-evens. And they're at very comfortable levels. They're at levels consistent once you get out past the very short term now. Break-evens are at at quite levels that are quite consistent with 2% inflation over time. So there's nothing happening with rates going up out there that suggests concern about inflation in the long term or anything like that. I mean, I look at these things pretty regularly. Same thing with surveys. Surveys are all saying that the public understands our commitment to 2% and expects us to get back there. So why are rates going up? It has to be something else. It must be, an expectation of higher growth or something like that. And that's a lot of what's been going on. I mean, you saw a big move, toward the end of last year, which was not to do with us. It was to do with other developments.
Well, you just mentioned that the public is expecting you to get back to 2%, and Americans overwhelmingly
tensions
are citing high prices, inflation as their number one concern. Can you explain to them why you're prioritizing the labor market, which seems relatively stable to most people, instead of their number one concern, inflation?
So we, as you know, we have a network of contacts in the U.S. economy, which is really unmatched if you go through the 12 reserve banks. So we hear loud and clear how people are experiencing really costs. It's really high costs. And a lot of that is not the current rate of inflation. A lot of that is just embedded higher cost due to higher inflation in 2022 and 23. So that's what's going on. And so the best thing we can do is restore inflation to its 2% goal, and our policy is intended to do that, but also have a strong economy where real wages are going up, where people are getting jobs and earning money, and we're going to need to have some years where real compensation is higher. It's positive, significantly positive. So nominal wages are higher than inflation, for people to start feeling good about the affordability issue. And so we're working hard on that. We're trying to keep inflation under control, but also support the labor market and strong wages, so that people are earning enough money and feeling economically healthy again.
Victoria. Hi, Victoria Guida with Politico. Just to follow up on that, I mean, this is now the third time that you've cut this year and inflation is around 3%. So is the message that you're sort of trying to send with that you're okay with where inflation is for now, as long as people understand that at some point you still want to get back to 2% because inflation is relatively stable where it is?
Everyone should understand, and the surveys show that they do, that we're committed to 2% inflation, and we will deliver 2% inflation. But it's a complicated, unusual, difficult situation where the labor market is also under pressure, where job creation may actually be negative. Now, supply of workers has also gone way down, so the unemployment rate hasn't moved that much. But it's a labor market that seems to have significant downside risks. People care a lot about that. That's their jobs. That's their ability, if they get laid off or if they're entering the labor force, to find work. So that's really important to people. The story with inflation, and we're well aware that this is a story at this point, is that if you get away from tariffs, inflation is in the low twos, right? So it's really tariffs that's causing the most of the inflation overshoot. And we do think of those as likely to, in the current situation, as likely to be a one-time price increase. Our job is to make sure that it is, and we will do that job. But right now, you've got this difficult balance, and there are risks to both sides. There's no risk-free path. If it was just inflation and the labor market was just really strong, and then rates would be higher, as they were for more than a year. We didn't have to worry about inflation. Sorry, about the labor market, because the labor market unemployment was very low. If you remember, when inflation was very high, there was a labor shortage, so we could focus entirely on inflation. Now it's different. We actually have risks to both, and I think we're doing the best we can for people. They also care about their jobs. They do care about affordability. And the best thing we can do there is both to support economic activity, but also, make sure that when tariff inflation goes down, disappears, inflation lands around 2%.
Elizabeth. Thanks so much, Elizabeth Schulze with ABC News. Just to follow up, you keep talking about job growth being negative. Why do you think job growth is so much worse than some of the official data? Why do you think job growth is, to follow up on your comments about job growth, why is it so much worse than the official data is suggesting?
Oh, well, we know, I think I don't think this is particularly controversial. It's very difficult to
With Whoop, train smarter, sleep deeper, recover faster.
Something of a systematic overcount. And so we expected, and they correct it twice a year. So the last time they corrected it, we thought the correction would be 800,000 or 900,000. I won't get the numbers exactly right. And that was exactly what happened. So we think that has persisted. And so there's an overcount in the payroll job numbers, we think, continuing, and it will be corrected. I don't have the exact month in my head right now, and that's just, I think forecasters generally understand that. So, and we think it's about 60,000 a month, so 40,000 jobs could be negative 20, and that could be wrong by 10 or 20 in either direction. But in any case, but the thing is, that's job creation in a way. That's demand. Labor supply has also come down quite sharply. So, if you had a world where there's just no growth in workers, and you really don't need a lot of jobs to have full employment, some people argue that's what we're looking at. But I think a world where
how
job creation is negative,
create jobs
I just think
when it's a monopoly. So it's hard for business owners to create new jobs if there's McDonald's. It's hard to build a restaurant when there's a McDonald's, a Burger King, and all of this shit is down the block, right? It's hard if if interest rates is at all-time highs. It's hard for people to take money out. So it's probably he's blaming it on job creation.
It's not a big part of the story yet. We don't know whether it will be, but for example, if you look at, you can't miss the big announcements of layoffs. And also companies saying that they're not going to hire anybody for a long time, and they cite AI. That's all clearly happening. At the same time,
was Janet Yellen same as Powell, very shy on words? They know exactly what they're doing. He just don't want to answer the question. Every central bank member is different. Bank of England Bailey, he would just not answer the question. He would be like, What did I just say the last time? So his demeanor is different. Lagarde from the ECB, like, she's very blunt. Like, she get pissed. She'd be like, why you keep answering me the same question? I just answered this question. Jerome Powell would just answer the question and just not give you an answer. So Jerome Powell would just just go around giving you is yes or no. And then he would give you like a 30-minute paragraph, just to tell you nothing, just to give you no answer. So that's just how he is.
This may be different. It's every time we have a wave of technology, we think, oh, this could put a lot of people out of work. What are they going to do? In the past, there's always been more work and higher productivity.
Yeah, glad
and
you like the live, man. Yeah, it's good. Join the private group.
Here, we're going to have to see.
We do
but
it every
right
day,
now is such early days. We don't think we see much. It's certainly not showing up.
No, Trump
in
just tells it what it is. Like, he don't care how it feels. Like, that's his problem. Like, he has no filter. He just instead of just like giving you because whatever he says moves the markets. Like, it sucks to see, like, we got this dovish reaction because of no rate hikes, and he's confirming that the labor markets is getting worse. So that's why this is happening.
In each group as well, there's some of that, but I would say they're also governors and they're people in both on both sides in both groups. I wouldn't put too much in that.
Okay, and just to follow up, please, given your growth upgrade, how would you factor in, or what would be the economic impact if the Supreme Court is to strike down the tariffs that they're currently hearing, please, in terms of growth and inflation? Thank you.
I really don't know. It would depend. It would depend on a whole bunch of things we don't know. So I can't really help you there.
Christine.
Thank you, Chair Powell. Christine Romans, NBC News. I wanted to ask you about how the higher income households are really driving spending right now. They're backed by...
Yeah, they're not answering anything. Yeah, like, it's interesting how this one went. Like, he really didn't... I could understand how... Yeah, he said, I can't help you. Yeah, he's getting... You could tell, like, when they start getting annoyed. Like, it's so funny. Because... yeah, it's just stupid ass questions. Like, it's just like, damn, like, this is what we got to deal with, So when we dissect the meeting, he confirmed that the labor markets is getting worse. He also confirmed that there's not going to be no sort of rate hikes. So that alone is what pushed dollar and equities higher. Pushed dollar lower, gold and equities are higher because he's confirming that the labor markets is still weakening, and that's their view. So remember what I said earlier. The fact that they're expecting weaker growth, it automatically puts pressure on inflation, because if he's expecting higher unemployment, right, weaker job numbers, people can't get money, people can't spend, right? So if that is happening, inflation is, he said he's not giving us a time frame of when inflation is going to hit near 2%. That's the problem, because he's like, well, I'm certain that we're going to bring inflation down, but it's like, okay, but when, right? So the markets ain't reacting to that. So right now is like, it's reacting to the fact that he said that there's no rate hikes. So that's what's going on. But the bigger picture, right, is what's going to happen next year. Because if the markets are not pricing in no rate cuts next year, we could see reversals of what we got today. And that could happen Asian session. All right. So just be cautious. We could see reversals Asian session. And then you look at the CME report, right? Because what's going to happen is that these expectations, right? I'll show you guys here. We could see the expectations of rates for next year could actually diminish, which I believe it's probably already like that. Let's see. Yeah, so we see that they're expecting, you see a no change of 75%. So right here for March is 50-50 pretty much. So they're expecting one rate cut in April, another cut in June. And okay, so far is 3. 4, let's see, but this could change at any time. So far they're expecting these rate cuts to happen next year. So let's see if that changes by the end of today, like Asian session or heading towards tomorrow. We're going to see if these expectations change. So I'm not going to screenshot it, but you can look at here. No change. That means that they're going to pause. Easing means they're going to cut, most likely. So we're just focusing on that. All right. So if markets now is pricing in a cut for next year, this is why we go lower. Yeah. I'm gonna send an update, and I'm gonna do an update for this in the Discord too. So I'm gonna have to just go to the central banks tab. So I'm gonna put it here so we could just get the update for it. So you remember this was the last one. Yeah, so I'll just give you guys an update there. And then I'm going to have to change this again. So you remember last one? It seems like it's the same shit. Like they're not really saying anything. And I would do the Bank of Canada as well. Yeah, so we're just getting this dovish reaction so far because of lower labor data. He's expecting labor data to push lower. And then he's confirming no rate hike. So that was the very clear giveaways. But they're confirming higher inflation. But he also just said we're not focusing on inflation. We're going to get the 2% anyway, right? So he's saying that our focus is the labor markets. And then he's confirming that the labor markets is getting worse. So that's why we got these reactions, because he's confirming to everybody that the labor markets is going to get worse. We got, Bitcoin is pushing higher now because of the weaker dollar and weaker yield. So Bitcoin moves like a commodity. So it moves like, you see silver, gold. Like gold is just more volatile, but it's moving like a commodity. So that's what's happening. And then equities is pushing higher too. So that's what's going on for it. So now we just focus on upcoming labor data. Housing is also a focus as well too. He's focusing on housing data. But he don't like the way they gather the information. Yeah, I closed my AU. I'm sick, but it's all right. I had good I held for like 2 weeks, so it's fine. But yeah, so that's why we got weaker dollar. So that's what's coming in now. And now this is probably to set the tone. So after an impulse, wait for a correction, like a pullback, or wait for a consolidation, okay? Because the Federal Reserve is still divided. So this could be just that overreaction, because we have to see if the markets still anticipate rate cuts next year. So that's what's going to be the focus, because the dot plot hasn't changed. So that means they're being data dependent. And if labor is not as bad as what they thought, expect the opposite directions. But he was blaming it on the fact that there's no new job creations. It's like, first of all, people don't want to work new jobs if they're paying shit like very bad wages, right? So he was saying that we're trying to get wages higher than higher than the inflation, which is, and I don't think that's going to be possible. So I feel like he's just saying a lot of wordplay. It seemed like he was trying to be politically correct with his answers, which is like something that they normally don't do, because the reality, they don't care about us. You know what I'm saying? Like, we're just numbers and statistics for the Federal Reserve. Like, he was actually trying to like care about the people, which I feel like that's more of a political question that he said, because he's not a politician. So that was interesting that he was saying comments to care about the people. Like, oh, we care about people paying for goods and stuff, and we care about you. Like, normally they don't talk like that. So that was kind of interesting that he said that, because he knows that when Trump speaks, he's going to say that Jerome Powell is ruining the United States. Like, they're very intelligent people, very intelligent. So when they say shit, is with a purpose, you know? It's not by accident. Yeah, have a good one, guys. I got to pick up my kids. So hopefully a bigger chance for cuts, right? As of right now, we got the reactions that it is, but I don't like the idea as of yet. We focus on the CME report, probably by Asian session. Like, let's see what happens Asian session. So we got the downside on the dollar. So wait for a pullback. And then if dollar pushes lower, then we could get ideas on more rate cuts. But economic data is what's going to confirm if we get more rate cuts. But from what I got, I don't personally think we're going to get rate cuts next year. Like, for like probably like 2. That's what I'm expecting. Like, that's what I'm expecting. Probably the same scenario, just data dependent. I didn't get the idea that they're going to cut rates aggressively. I didn't get that. I got like the reactions is like right now, but we don't have the market reactions for next year. So that's why I say just be cautious of these moves. This is just the reaction from what he currently said about what he sees now. But like forward guidance, to me, that he really didn't confirm it. And the dot plot didn't confirm it. So that was pretty interesting to see these type of reactions, because to me, it was like, I understand why we got the dovish reaction, because what he confirmed about the labor markets, and he said the labor markets is more of a priority than inflation. But inflation, they said that all the Fed members kind of confirmed that inflation is still high. So like, why are you cutting interest rates? That's why this is why the news reporters, right, they're asking him, well, you're saying that inflation is still high, but you're still cutting interest rates. So does that mean you're going to cut, and then hike, which I did 34, like what they did 50 years ago? And that's when he was like, no, we're not going to hike interest rates. And that's when the dollar dropped. So I understand why the reporters asked him that, because if you're saying inflation is still high, why are you still cutting interest rates, right? So is it because Trump is pressuring you to? So that's where the head scratcher is, because how are you going to bring inflation back to 2% if you're still cutting interest rates? And then you're saying that we're not in restrictive territory no more. So y'all could see like how it goes against what he's trying to do. It doesn't make sense. So the only way like I could see inflation dropping is if we have a disaster, like what happened with 2020 again, because then nobody works, then they have no choice but inflation to lower. Right. So that's the only thing, is like a disaster happens and they already know it, which is scary to think about, but it's insane. It goes against each other, because like now it's like, why are you still cutting rates? That you should pause rates. So you see what I'm saying? Like, so this is why, like, from a bigger perspective, it doesn't really make sense unless he's expecting a recession and he's just not saying it. Right. So he's saying, well, the labor market is getting bad. It's probably worse than what we think. So that's probably why he's still comfortable cutting interest rates, because he expects the labor markets to be worse than what he thinks. Yeah, it's best to wait until after the noise. Like gold, all it did is just push to the highs. This is the 4 hour, so we're at the top of the range. So Asian session would probably be a good opportunity for gold, probably waiting until like after 9 p.m. to see what happens, It'll be a good thing. Watch out for Trump headlines about Venezuela, like anything about like geopolitical tensions. Like if we go to war, if boots are on the ground, that would probably cause a risk off market. That will cause gold to spike higher. Equities might push lower if we see any like military action. All right. Ideally, well, you know exactly when to enter during FOMC meeting. I sat on my hands today, not gonna lie, especially. Yeah. I mean, Eddie, because the fact that you sat on your hands, that shows that you know what you're doing, right? Because if it's not clear, then most likely it's just not clear. So don't try to overcomplicate it. Just because the markets push lower, it doesn't mean that you missed out on something. It's just like I said, yeah, just because you missed out on it doesn't mean, like, the reason I understood why it dropped, but it doesn't mean I took sells on the dollar, right? Because I understood why, but it wasn't a reason why I wanted to enter. Like if the dot plot would have showed more rate cuts coming in and then this would have happened, then I'd have took sells. Okay. But what he was saying, it was in both directions. To me, I'm thinking longer term. So I'm like, I understand the sells and I should be in the sells at $1 and buying equities, but I'm like, how are you cutting interest rates and you're still confirming inflation is higher? Like it just doesn't make sense, So to me, I'm like, he's not really giving us anything. Like to me, I'm like, this guy is like literally fucking us up, and that's why I didn't really take a trade. This one was interesting because he wasn't really trying to give us a direction, like he's, to me, I felt like he was more hawkish, more from forward guidance wise. But all right, guys, I'll see you guys in the chats. Have a good one.